Welcome to the Deep Dive. Ever wonder how governments handle money that, well, isn't really theirs to spend as they please? We're diving into fiduciary funds today. Think of it like understanding when the government acts as a trustee.
Right, managing assets for other people or groups.
Exactly. Whether you're just curious about public money or maybe this is relevant for your work, we're going to unpack what makes these fiduciary activities distinct.
And look at the different kinds of fiduciary funds involved based on our sources.
So let's start there. What actually defines a fiduciary activity for a government?
Okay, there are really three core things to look for. First, the government has to control the assets.
Control them, meaning they hold the cash or investments.
Yeah, they either hold them or they have the ability to direct how those assets are used for the specific people they're meant for. Even if there are external rules about how they can use it, the government still has that control element.
Okay, so restrictions don't negate control. What's the second point?
The assets can't come from the government's own source revenues.
Meaning not from their regular taxes or fees they collect for providing services.
Precisely. It's not their money generated through their normal operations. And third, the assets need to have at least one of two specific sets of characteristics.
Okay, what are those?
Either one, they're held in a formal trust where the government isn't the beneficiary, or they're dedicated to providing benefits and legally protected from the government's own creditors.
Right. So safe if the government gets into financial trouble.
Exactly.
Ooh.
Or the second possibility is that the assets are for the benefit of individuals, but not derived from the government providing services to those individuals.
Yeah.
And critically, in the second case, the government doesn't have significant administrative involvement or direct financial involvement with the assets.
Okay, administrative involvement and direct financial involvement. Can you break those down a bit?
Sure. Administrative involvement is things like monitoring whether recipients are complying with requirements or determining who's eligible beyond just basic criteria or having discretion over how the money is allocated.
So making active decisions about the money.
Right. And direct financial involvement means the government is providing its own money, like matching funds, to the program. If the government isn't doing those things, it points towards it being a fiduciary activity.
That makes sense. That separation seems really key.
It is.
So based on these criteria, our sources lay out four main types of fiduciary funds. You've got custodial funds,
Investment trust funds,
private purpose trust funds,
and pension and other employee benefit trust funds.
Let's maybe tackle custodial funds first. What's the main idea there?
Custodial funds are kind of the default fiduciary fund. They're used for temporarily holding cash for authorized recipients, individuals, private organizations, or other governments when one of the other trust fund types isn't appropriate.
Like a holding area.
Sort of. A common example is tax collection funds. Think of a county collecting property taxes for itself, the local school district, and maybe a city within its borders.
Right.
The county holds the money temporarily and then distributes it out, maybe keeping a small fee for the collection service. That's custodial.
Any other examples?
Yeah, things like clearance funds where money comes in and is distributed based on a formula, like certain pass-through grants. Or even sometimes things like alimony or child support payments collected by a state agency. The key is usually minimal government discretion or involvement beyond just collecting and dispersing.
Gotcha. And the accounting for these?
It's fairly straightforward. You'll see a statement of fiduciary net position, basically assets like cash and receivables, and liabilities like amounts due to others, and a statement of changes showing the additions, like tax collections and deductions, like payments out.
Our materials mentioned the Progressive Township example showing just that. Okay, next. Investment trust funds.
Right. These are specifically for reporting the external portion of investment pools run by a government.
External portion.
Yeah. So if a state runs a big investment pool and allows local cities or counties to put their money in alongside the state's money, this fund tracks the assets belonging to those outside cities and counties.
Okay, makes sense. They use full accrual accounting, report investments at fair value. Anything else key?
Notably, they don't prepare a cash flow statement. And when the sponsoring government itself puts money in or takes it out, it's treated just like any other external party transaction.
Interesting. Okay, what about private purpose trust funds? The name sounds specific.
It is. These are for trust arrangements under agreement where the principal and income benefit specific individuals, private organizations, or other governments. But crucially, they're not for pensions and not investment trusts.
Example.
A classic one is escheat property.
Like abandoned bank accounts or unclaimed assets.
Exactly. If the government holds that property specifically for potential rightful owners or their heirs, it might go into a private purpose trust. Another example could be retainage on construction contracts held until the work is fully approved.
Okay. And the last type, pension and other employee benefit trust funds. This seems pretty self-explanatory.
It largely is. This is where governments account for pension plans, both defined benefit and defined contribution, and also other post-employment benefits, or OPEB, like retiree health care.
Same accounting, generally. Full accrual.
Yes, full accrual, statement of net position, statement of changes, assets generally at fair value. The additions are things like employer and employee contributions and investment income. Deductions are benefit payments, refunds, and admin costs.
The Progressive Township example in our sources showed this too, highlighting the restricted net position. It also mentioned the net pension liability isn't actually on this statement.
Correct. That liability is reported in the government-wide financial statements and the governmental or proprietary fund statements, if applicable, but not within the pension trust fund's own statements. It's mainly disclosed in the notes for the trust fund itself.
So wrapping this up, the big takeaway seems to be that fiduciary funds are all about the government acting as an agent or trustee.
Holding and managing assets for others, not from its own activities or for its own programs. The rules on control, revenue source, and involvement are key differentiators.
It really makes you think, doesn't it?
Right.
Beyond the obvious, like collecting taxes for other units, what are maybe some less common or, unexpected ways the government might find itself acting as a custodian or trustee for its citizens, or maybe other entities? Definitely something to ponder.